Peter Kraus, CEO and Chairman of Aperture Investors. I don't want to put words in your mouth, Peter, but I think you think we're restrictive. I think you think that we are slowing a little. You're seeing it somewhere. As a result, we will see some cuts, and that's going to make small caps just take off. Do you need to even say anything now?
I do think that.
Can you fill in the blanks?
Fill in the blanks?
Convince me number one, convince me you're seeing pockets of weakness in the economy. Where are they? And why aren't they obvious to everyone?
Well, I think when it's obvious, you have a recession or you have significant decreases. But you can see earnings growth slowing, particularly in the small cap space. If you looked over the last 2 quarters, you saw retail stocks, consumer discretionary stocks having slower growth over that time period. And even the large cap stocks, what Andrew referred to, the Magnificent Seven, whose revenues continue to grow at faster rates than everybody else, we see that evidence that's actually there. And there's some stocks that have actually reported that, small cap stocks have reported that in the next few quarters, they think their revenues are going to accelerate. And so, there's a feeling in that sense that executives think they're at the trough. And if, in fact, you're going to have lower rates, and if, in fact, over the last 2 years, higher rates have restricted growth and caused small cap to underperform large cap by 9% per year for 3 years, big number. And over long periods of time, small cap and the S&P basically are equal to each other. Vols are different, but, you get equal returns. There's really no reason to believe that if interest rates are going to decline, and we're not going to have a recession, and we could, but if we didn't, small caps are going to outperform.
I guess the if is if interest rates are going to decline, because we thought 6, and then maybe 5 cuts, and then, maybe we'll get 3. And now there's people saying, I've had people say we'll get 1 cut. I don't even know why you would cut 1. That makes most sense. But that's assuming that the next move is not an increase if inflation stays bad or even comes back.
Yeah, I think there's no chance for an increase.
And we are restrictive now.
Yes, I think there's no chance for an increase, but the Fed is in definitely a tricky situation. If they cut rates too quickly, then and inflation accelerates, that's a terrible place for them.
Is your whole thesis based on them cutting for small caps?
Yes, I do think that the Fed has to cut at some point. And my thesis is that they're not going to increase rates. My thesis is that they will be slow in cutting rates. I've said that for
why cut it all? Because you think that there are
because you have an unnaturally high cash rate. You don't need cash rates at this level unless you are attempting to restrict growth. And so there's every reason to believe that they will cut rates and get down to a normal position.
Even with inflation pointing in the wrong direction, I mean, the numbers we got on Friday, the PCE.
Well, the numbers are erratic. They're not, they're not just going up and they're not just going down, and we'll see what the numbers are this week.
3 months, they're going up, and they're revising the last several months even higher.
Some of the revisions have been higher, and look, I'm the first hawk on inflation sticky. And people said inflation is just going to fall like a rock, and it never has, and I didn't think it would. But I do think you've had 2 years of restrictive activity here, and you're going to, you're beginning to see breaks in the broad economy. I had Altice last week, the largest capitalization structure in Europe, was downgraded to CCC. And that's a major company. We're going to see more of that. We've seen banks struggle. We've seen real estate struggle. There are things out there that are obviously impacted by higher rates. And so we need to see consistency in the data, and the Fed said that. And that's not, don't be confused over that. That's what they mean.
Do you worry about stagflation?
No, I'm not worried about stagflation. If I have a worry, it's that we have a recession. That would be my concern.
The move we've seen in the markets, you attribute to what?
Well, again, if you look over time, the markets are not really outperforming by that much. In fact,
they finally caught up after a couple of years.
Yeah, in fact, from end of 21 till today, I think the compound growth rate is like 6% or 7% or even less. I think it's 4%. So it's not like the market is,
But
going
was it
up.
the easing, the expected easing? Was it the strength of the economy with as far as earnings? What was it that was it the? I mean, sentiment was so negative. It was the most hated bull market in the world last year, the entire year, right?
Yeah.
I don't think you were very bullish for a while.
Yeah, it took me a while to churn, but I think in the last 6 months, the markets look attractive enough to invest in over the long run. And I do think the Fed is going to have to reduce rates. And if you don't have a recession, which we could, but if you don't, then I think the market's cheap.
Do you think that there's some Keynesian benefits going on? I don't know whether, the worry about Keynesian benefits is that they come due at some point down the road. There's no free lunches. But do you think some of it is all the money allocated for chips or infrastructure or EV transition, any of that stuff? Is that all that money sloshing around still?
Well, I definitely think that some part of the fast rise in inflation was a reaction to COVID and the fiscal stimulus that was created.
Is that some of that still around?
And yeah, sure, but it's less than it was, and it's petering out. You see consumers increasing their borrowings. One of the great benefits we got out of very low interest rates is, I don't know what the percentages are, but they're 60 to 70% of homeowners have incredibly low interest rates on mortgages, at 3.2%. And so if you think about the discretionary income that creates at the consumer level, that's significant. And that's still there. That's not going anywhere. And people are in control of that. If they want to sell their homes and pay higher rates, they can. But if they don't, they'll continue to have that discretionary income. So I do think that that's helping this situation. I think that's helping the Fed keep rates higher and slow the economy down. And I do think that may be one of the reasons why there's not a recession.
That's the last thing I was going to ask you about. I forgot.
It adds to the inequality, though. It adds to the inequality. People who are first-time homeowners.
Sure,
people who
absolutely,
are forced to move.
Absolutely. And that's one of the reasons why, actually, if you get to some stability, you actually see a pickup in housing, because there are a lot of first-time homeowners who haven't been able to buy, and because prices have been elevated. And that, there is pent-up demand. You look at the rental markets. That's part of the reason why inflation doesn't come down that fast.
Right.
Because people have to rent.
When are we going to see some crowding out in terms of if we got every time we do another auction for the $33 trillion, you wonder, how do rates come down? I mean, it'd be nice because the debt service would be, but how do we get people to take the paper with lower yields?
Well, so let's talk about where we are in the yield curve. So now you're talking about further out in the yield curve, not the short paper. So the question is the 10-year at 4.2% fairly priced? And can you really get people to buy all the paper they have to buy at 4% or 3.5%? And personally, I've never thought that. I actually think that the U.S. government's going to have to pay up.
It still happens.
And it's still happening. And I think you've got to get 150 to maybe 200 basis points of real interest, real return.
To go 10 years.
And so if you have a 2%, inflation rate, you're going to have 4 or, at least 3.5. And so I don't think it's any surprise at all where we are in the 10.
So you're talking about short rates coming down. But
short rates will come down.
And long rates could go up then.
Long rates could go up. And you wouldn't be shocked if they did.
No.
Because what if inflation sort of bottoms out at 2.5? And you have a 2% real rate, that's 4.5. And 4.5%, 10-year Treasury, that's not even unusual. In fact, a 4% Treasury at 10% rate is more unusual.
Right.